the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're tuning in to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market has closed for today, the biggest movers, sectors, and of course the companies to watch. But as always, a quick recap of some key movements. While Singapore shares fell today as investors continue to monitor developments on the global trade front. So if you look at the Straits Times Index, it was down 0.36% at 4,214 points at about 1:12 p.m. Singapore time, and that is with a value turnover of 805 million Sing dollars seen in the broader market. Now let's take you through the closing numbers. The STI ended in the red as well, down 0.24% at the end of the trading day at 4,219 points. In terms of value turnover, we are looking at 2.08 billion Sing dollars. Gainers trailed losers 222 versus 342. Top advances for today, we've got for you iFast, GMXUSD, and BRC Asia. And top decliners, we've got here ASUS, DBS, and UOB. And in terms of counters to watch, we have Hotel Properties Limited, after the property group said yesterday that it is still in discussions with parties over the redevelopment of Forum, the shopping mall, and voco Orchard Singapore. Now, elsewhere from US President Donald Trump saying that India may get a 20 to 25% tariff on goods exported to the US, to market movements ahead of big tech earnings and a Fed rate decision. We've got more international headlines in focus. And joining me today on the line is Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Welcome back to the show, Thilan. How are you today?
I'm great. Thanks for having me on the show.
Great to have you. And Thilan, let's start with the Singapore stock market first before looking at global markets. How did the STI fare today? Any surprises when we look at the biggest movers and the sectors that they lie in?
Yeah, as you said, I think the STI is down about 0.25 percentage point, with the index struggling ahead of major macro announcements such as the Fed's decision tonight, as well as a heavy load of company reporting that is also coming out. Now, a notable gainer on the big caps was actually Yantian Shipbuilding, which was up about 3.5% after it announced some major orders from Korea CK Line for 4 feeder box ships. We also generally saw the REITs, especially the more domestic-facing names, doing well, such as CapitaLand Ascendas REIT, CICT, FCT, on fairly resilient operational readings from Singapore. Now, on losers, we saw SIA down close to about 2%, following their fairly weak earnings numbers, where earnings saw a fairly big plunge. We also saw the 3 big banks, DBS, UOB, OCBC, all in the red today. Going into the second quarter results, we are expecting to see some earnings momentum coming off for them as they report. Finally, we saw Singtel also giving up some gains that they have made recently, but we think a lot of that is mostly profit-taking.
Okay, and if we zoom in on some of the counters to watch, Thilan, earlier we talked about Hotel Properties Limited, because the property group there said yesterday that it is still in discussions with parties over the redevelopment of Forum, the shopping mall, and voco Orchard Singapore. This came after news broke that HBL was in talks to sell its stakes in the 2 marquee assets along Orchard Road. What does the news mean for the firm, and how have investors reacted thus far?
Yeah, so I think we have to be sensitive that currently a lot of these are only just negotiations and discussions. So, but now assuming that, these discussions result in any firm transaction, we actually fall on the side of thinking that it will actually help unlock value. We have seen quite a lot of corporates going through this journey of unlocking value from a lot of their latent assets on SGX. A lot of these that HPL have are legacy assets. A lot of them sit on prime freehold land. Potential redevelopment of these adjacent pieces of land parcels could actually dovetail quite well with what the government is also trying to do to rejuvenate the shopping district and help uplift the western precinct of Orchard Road. So I think investors will take it positively, but I think we also have to bear in mind that right now they're mostly just discussions.
Okay, and another counter to watch at Thilan for today is Keppel REIT. Keppel REIT reporting there a 2.9% year-on-year decline in its H1 FY 2025 distribution per unit. We're looking at 2.72 Singapore cents. Now, property income rose 9.1% to 136.5 million Sing dollars. That is from 125 million Sing dollars in the same period a year ago. What do you make of the latest results, and generally speaking, how have S-REITs fared thus far?
So specifically on K-REIT, I think what we're seeing is the impact of repricing of interest rate swaps, which led to higher borrowing expenses and which lowered their DPU. Now, the year-on-year comms were also impacted by some of the management fees being taken out in cash. Operations was a mix of positives and negatives. I think the Singapore business continues to enjoy good rental reversion, but there is also some occupancy slippages as well. Now, the key is to keep an eye out on gearing, which has been rising. And so the question to ask is, how will management address that? So that's something that we'll be watching out for. Going into the broader S-REIT sector, the results are coming out not too different from our expectations. On DPUs, we are seeing a mixed trend. Savings in financing and prior accretive acquisitions have helped some of the REITs to grow their DPUs. On the other hand, some of them are being impacted by sectoral challenges, especially in sectors like hospitality. We're also seeing continued repricing of interest rates and cross-currency swaps as well. Local operations are performing relatively better than overseas operations, but even then we are still seeing some occupancy slippages here as well. Finally, I think interest savings have been a positive feature that we've seen across most of the REITs. And also we haven't seen much impact from the Trump tariffs either.
Okay. And, let's talk about what's going on in the region. You talked about Trump, Thilan. U.S. President Donald Trump, he said that India may be hit with a tariff rate of 20 to 25%, but he cautioned that the final levy still had not been finalized as nations negotiate a trade deal ahead of an August 1st deadline. How far is this in line with the expectations? I mean, I believe officials are looking at below 19%. What could this mean for Indian MNCs with exposure to the U.S.?
There is still a lot of unknowns when it comes to Trump's tariffs in India. There is still the potential that, there will be a deal pulled out of the hat in the last minute. We've seen that with the EU, and we've seen that with, Japan, Indonesia, and so on. Now, a blanket countrywide 20 to 25% tariff would be harsher than expected, but it is comparable with what we've seen with Vietnam, Malaysia, Philippines, but lower than the 36-40% or so we've seen for Thailand, Cambodia, Myanmar, and so on. Now, when it comes to MNCs and corporate exposure, it'll really depend on whether they have tariff good exposure. Some of the key exports out of India into the U.S. are things like textiles, pharmaceuticals, machinery, chemicals. While some of these will be subject to sectoral tariffs like pharma, which is still at zero, others will face more general tariffs, and that could actually have a big impact on how these companies trade. On the other hand, there is significant services exports from India to the U.S., particularly in IT. Now, these are unlikely to be affected, at least for now.
Okay. Now, if you're just tuning in, we're in conversation with Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. And Thilan, let's talk about corporate news. Samsung Electronics surprised $16.5 billion chip-making deal with Tesla. That has breathed new life into a foundry business, all but written off by many investors. Now, if we look at Samsung Electronics, its stock has risen 9% since the news about the agreement on Monday, bringing Samsung gains in July to over 20%. How far, though, can this bring Samsung on par to compete against fellow industry players like your TSMC and SK Hynix?
Now, the specific deal is to fabricate A16 next-gen chips for Tesla. Now, the earlier version, the A15s, were actually done by TSMC. These chips will be fabricated in Samsung's U.S. plant in Taylor City, which will go live next year. Now, one key takeaway is that Samsung's yield on their 2-nanometer chips is reaching viable levels with limited defects. This is finally giving a boost to help them reposition themselves in this whole AI playfield. If the yields continue to remain strong at this at the production level, it can finally position itself as a competitor against TSMC and Hynix. But also keep in mind that Hynix mainly focuses on the memory chip market, where it has overtaken Samsung's DRAM and high bandwidth memory or the HBM market. Catching up to Hynix in that part doesn't seem likely without any major breakthroughs in memory chip technology. However, with the new chip deal with Tesla, there could be more opportunities that Samsung gets to catch up with TSMC.
Okay, and speaking of Tesla, Thilan, a Reuters report citing a source familiar with the matter said South Korea's LG Energy Solution, or LGS, has signed a $4.3 billion USD deal to supply Tesla with energy storage system batteries, and this is as Tesla looks to reduce reliance on Chinese imports due to tariffs. Any thoughts on that later move by Tesla? Seems like there are more activities surrounding the company and more news surrounding it.
For sure. Just as background, I think the batteries will be supplied from LG's factory in Michigan, which is one of the few lithium iron phosphate battery production facilities located in the U.S. The deal will allow Tesla to reduce their reliance on Chinese imports, which are subject to a much more steeper tariffs. It also helps them move to a tariff-compliant supply chain, as there is high chance that tariffs are likely to outlast the Trump administration. We see this also as a broad attempt by Tesla to strengthen its energy division. Now, this could be signifying that management got confidence in their utility scale storage growth to offset some of the cyclical headwinds that their EV business is facing. This division has a lot of potential to contribute to the longer-term strategic upside of Tesla. Now, from LG side, it allows them to pivot to stationary storage amid all these weakening fundamentals in the EV sector, especially since it's nearing the end of the U.S. consumer EV subsidies.
Okay. Finally, before we let you go, Thilan, how are global markets moving ahead of big tech earnings from Microsoft, Meta? Aside from that, I believe we've got Ford and Robinhood as well. We've got a Fed rate decision. Are you expecting any major surprises versus what markets are pricing in right now?
Yeah, I think there's a lot of surprises out there. But I think the biggest one is on the Fed. I think if there is a cut, now that will be a major surprise. But having said that, our own house view is that the Fed will stay put this cycle, despite the pressure that the White House is putting on the Fed. Cuts are more likely to come more towards the second half, towards the end of the second half, and going into next year. Now, when you talk about Meta and Microsoft, I think investors are going into these results releases on a very, very bullish tone. Consensus is for very strong earnings growth with a potential for a beat in terms of expectations. Specifically on Meta, there are some concerns on the impact of tariffs on digital advertising. So this is something that we'll be watching out for. But the real story is how well the company is rapidly integrating AI across its ecosystem. AI is helping to enhance user experiences, and there will be some attention on if these are actually driving users to spend more time on the Meta ecosystem. Now, on Microsoft also, investors will be looking out on how the company is monetizing AI through pushing out adoption of things like Copilot, chatbots, cloud computing. Investors will also be watching out how ambitious Microsoft's AI spending will be going into 2026, because that will actually give a clue across the industry and across the ecosystem on how far how mature the AI cycle is. So quite a lot to watch out for.
I suppose so. Thanks so much for the insights today, Thilan. That was Thilan Wickramasinghe, Head of Equity Research at Maybank Securities. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.